I'm Larry Fink, and in 2022, something happened that financial textbooks said couldn't happen. Both stocks and bonds fell at the same time. Hard. The S&P 500 dropped 18%. The bond market dropped 13%. For the first time in decades, the 60-40 portfolio, 60% stocks, 40% bonds, the strategy that's been the gold standard since the 1980s, failed. And it didn't just underperform, it got crushed. Most investors lost 15 to 17% that year. And most people still don't understand what happened or why it matters. But I do. Because I've been in this business for 50 years. I started on Wall Street in 1976. Today, I run BlackRock, and we manage over $11 trillion in assets. That's more than the GDP of every country in the world except the United States and China. And from where I sit, managing this much capital, talking to the smartest investors on the planet every single day, I can tell you, 2022 was a turning point. The investment world changed that year. And it's not changing back. The problem is, most people's portfolios haven't adjusted. Your financial advisor is probably still recommending 60-40. Your 401k is probably still structured that way. The target date funds millions of Americans are invested in, still using the old model. But institutions? Pension funds that manage trillions for teachers, firefighters, and government employees? Sovereign wealth funds that manage entire nations' wealth? They've already moved on. They're not doing 60-40 anymore. They're doing something different. And if you don't understand what replaced it, you're going to spend the next 10 years underperforming, taking more risk than you realize, and watching your retirement goals slip further away. So in this video, I'm going to explain 3 things. First, why the 60-40 portfolio died in 2022, and why the fundamental assumptions behind it no longer work in today's world. Second, what's replacing it, the new portfolio allocation that institutions are moving toward. We call it 50-30-20. And third, how you can actually implement this in your own portfolio, even if you're not managing billions. Practical steps you can take this week. This isn't theory. This isn't academic. This is what we're actually doing at BlackRock, with real money, with real clients, managing real retirements. Let's get into it. Let me start by explaining what the 60-40 portfolio was and why it worked for so long. Because you can't understand why it died until you understand why it lived for 40 years. The 60-40 portfolio is simple. 60% of your money goes into stocks. 40% goes into bonds. That's it. Rebalance once a year. Hold for decades. And for 40 years, from 1980 to 2020, this strategy was brilliant. Absolutely brilliant. Here's why. Stocks and bonds were negatively correlated. That means when stocks went down, bonds usually went up, or at least stayed stable. This created balance. This created protection. Let me give you a concrete example. 2008, the financial crisis. The worst market crash since the Great Depression. Stocks fell 37% that year. Devastating. But bonds? Bonds went up 5%. So if you had a 60-40 portfolio, yes, your stocks got hammered, but your bonds cushioned the blow. Your overall portfolio was down maybe 22%, 23%. Still painful, but survivable. And you recovered quickly because you didn't panic and sell everything. This is what financial advisors mean when they talk about diversification. They don't just mean owning different stocks. They mean owning different asset classes that behave differently, that move in opposite directions. And for 4 decades, this worked like clockwork. The crashes of 1987, 2000, 2008. Every time stocks fell, bonds provided stability. Every time inflation was low and the economy was growing, stocks delivered growth. The 60/40 portfolio delivered average annual returns of about 9% from 1980 to 2020. Not spectacular, but steady, reliable, boring. And boring is exactly what you want for retirement savings. But here's what most people don't understand. The 60/40 portfolio worked because of one specific economic environment, an environment that no longer exists. From 1980 to 2020, we had 40 years of falling interest rates. When I started in this business, the 10-year Treasury bond was yielding 15%. 15%! By 2020, it had fallen to 0.5%. Falling rates meant bond prices rose for 40 years straight. It was the greatest bond bull market in history. And that's why 60/40 worked so beautifully. You had stocks growing and bonds appreciating. Both parts of your portfolio were making money. But that environment is over. Completely over. And 2022 was the year the market proved it. Let me walk you through what happened in 2022, because this was the wake-up call that changed everything. Coming out of COVID, governments around the world had printed trillions of dollars. The Federal Reserve's balance sheet exploded from $4 trillion to $9 trillion in just 2 years. Money supply went through the roof. And then, predictably, inflation came roaring back. In 2021, inflation hit 7%. By mid-2022, it was 9%. The highest inflation in 40 years. The Federal Reserve had no choice. They had to raise interest rates aggressively to fight inflation. In 2022, they raised rates 7 times. 7 times in 1 year. That's the fastest hiking cycle since the 1980s. And here's what that did to portfolios. Stocks fell. The S&P 500 dropped 18%. Technology stocks, the Nasdaq, dropped 33%. That's expected. Rising rates hurt stocks, especially growth stocks. Everyone knows that. But here's the problem. Bonds fell too. The Bloomberg Aggregate Bond Index, the benchmark for bonds, fell 13%. Let me repeat that. Bonds fell 13%. That's the worst year for bonds since the index was created in 1976. This was the crisis. Both parts of the 60/40 portfolio fell at the same time. There was no diversification. There was no cushion. There was no safety. If you had $1 million in a 60/40 portfolio at the start of 2022, by the end of the year, you had about $840,000, a 16% loss. And there was nowhere to hide, because both stocks and bonds were getting destroyed simultaneously. Now, why did this happen? Why did bonds fail to protect you? Because the fundamental assumption broke down. Remember, bonds rise when interest rates fall. But in 2022, rates weren't falling. They were rising, fast. And when rates rise, existing bonds lose value. It's just math. A bond paying 2% isn't worth as much when new bonds are paying 4%. so bond prices dropped. And this is where 60-40 died. The entire strategy was built on the idea that when stocks fall, bonds go up, or at least stay stable. But that only works when interest rates are falling or stable. When rates spike up, like they did in 2022, both stocks and bonds fall together. And the correlation broke. Stocks and bonds became positively correlated, meaning they moved in the same direction, down. Now, some people will say, Larry, 2022 was an outlier. It was a weird year. Things will go back to normal. No, they won't. And here's why. We're in a different economic regime now. Interest rates are higher. The Federal Reserve's target rate is around 5%. The 10-year Treasury is yielding 4% to 4.5%. We're not going back to zero. We're not going back to negative rates like Europe and Japan had. Those days are over. And in this new regime, higher rates, persistent inflation, geopolitical instability, the 60-40 portfolio doesn't provide the protection it used to. It's not that stocks and bonds will always fall together, but they can. And they will more often than they did over the past 40 years. So, what do you do? If 60-40 is dead, what replaces it? That's what I'm going to show you next. At BlackRock, we've been working on this problem for years, and the solution we've developed, and that other major institutions are now adopting, is what we call the 50-30-20 portfolio. Let me break it down. The 50-30-20 portfolio allocates your money this way. 50% in stocks, equities. This is still your growth engine. Over the long term, stocks are how you build wealth. That hasn't changed. 30% in bonds, fixed income. We're not abandoning bonds completely. They still have a role, but it's a smaller role now, and we're more selective about which bonds we own. And here's the key. 20% in private markets and alternative assets. Private infrastructure, private credit, real estate, commodities. Assets that aren't publicly traded, that have low correlation to stocks and bonds, and that provide inflation protection. Now, I know what you're thinking. Larry, alternative assets? Private markets? That sounds complicated. That sounds like it's only for billionaires and endowments. It used to be, but it's not anymore. And that's exactly why we're having this conversation. Because access is opening up. And if you don't understand this shift, you're going to miss it. Let me explain each component. You still need stocks. You still need that growth engine. But here's the key. Diversification within your stock allocation matters more than ever. You want U.S. large cap, the S&P 500, but not exclusively. International developed markets, Europe, Japan. Emerging markets, China, India, Brazil. Small and mid-cap stocks. Dividend-paying stocks for income. The days of just owning the S&P 500 and calling it done, those days are over. You need global diversification because growth is happening everywhere, not just in the U.S. At BlackRock, we're seeing our institutional clients go from 80% U.S. stocks to maybe 60% U.S., 40% international. They're diversifying geographically because they recognize that innovation, growth, and opportunity are global now. Bonds still have a place, but it's a smaller allocation, and we're much more intentional about which bonds we hold. Here's what we focus on. Short to intermediate duration, not long-term bonds. Long-term bonds are too sensitive to interest rate changes. If rates rise, long bonds get destroyed. Short-term bonds with maturities of 1 to 5 years are much more stable. Tips: Treasury inflation-protected securities. These adjust for inflation. So if inflation spikes again, you're protected. Your principal adjusts up automatically. High-quality corporate bonds, investment grade. Not junk, not speculative. Bonds from stable companies with strong cash flows. And floating rate bonds. Bonds where the interest rate adjusts with market rates. So if rates go up, your yield goes up too. You're not locked into a low rate. The key is, bonds are now for stability and liquidity, not for growth. You're holding bonds so you have something to sell when stocks crash. You're not expecting bonds to deliver big returns anymore. And now, the game changer. The 20% allocation to private markets and alternative assets. This is where the real innovation is happening. This is where institutional investors have been making money for decades. And this is what's finally becoming accessible to regular investors. What goes in this bucket? Private infrastructure. Roads, bridges, airports, data centers, energy pipelines, water systems. These are real assets that generate steady cash flows, that have inflation protection built in because tolls and fees rise with inflation, and that have low correlation to stocks. We just acquired Global Infrastructure Partners for $12.5 billion. Why? Because we believe infrastructure is one of the best asset classes for the next 20 years. The world needs $68 trillion in infrastructure investment by 2040. This is a generational opportunity. Private credit. Lending directly to mid-sized companies that don't access public bond markets. These loans yield 8 to 10%, sometimes more. And unlike public bonds, many private credit deals have floating rates, so you benefit when rates rise. We acquired HPS Investment Partners for $12 billion because we see the private credit market doubling from $1.5 trillion today to $4 trillion by 2030. Real estate. Not REITs, which are publicly traded. I'm talking about direct ownership of real estate through private funds. Apartments, warehouses, office buildings, industrial properties. Real assets that generate rent, that appreciate over time, that hedge inflation. Commodities. Gold, oil, agricultural products. These tend to rise when inflation rises. They're a hedge. Now, here's why this 20% allocation matters so much. These assets have low correlation to stocks and bonds. When stocks crash, private infrastructure doesn't crash with it. A toll road keeps collecting tolls. A data center keeps generating rent. These assets are insulated from public market volatility. And, historically, pension funds that have this kind of allocation have outperformed 401k plans by about 0.5% per year. Doesn't sound like much, but over 30 years, that 0.5% compounds into hundreds of thousands of dollars extra in retirement savings. So why doesn't everyone do this? Why is 60-40 still the default? Because until recently, private markets were closed to regular investors. You had to be an institution or ultra-wealthy to access them. But that's changing. At BlackRock, we're building products that bring private markets to 401k plans, to target date funds, to everyday investors. It's happening right now. And that's why understanding 50-30-20 today gives you an advantage. Because you're early. You're positioning before the crowd figures it out. Okay, so now you understand the theory. 60-40 is dead. 50-30-20 is the replacement. But how do you actually do this? How do you implement a 50-30-20 portfolio? Let me give you practical steps. First, figure out where you are now. Log into your 401k, your IRA, your brokerage account. Look at what you actually own. Most people think they're diversified, but when you actually add it up, they're 80% stocks, 10% bonds, 10% cash. Or they're 60-40, but they've never rebalanced, so it's drifted to 70-30 without them noticing. Write it down. Get clarity on your current state. The 50-30-20 allocation is a starting point. It's not a rigid rule. Your specific allocation should depend on your age. If you're 30, you can afford to be more aggressive. Maybe 60% stocks, 20% bonds, 20% alternatives. If you're 65 and retired, maybe 40% stocks, 40% bonds, 20% alternatives. Your risk tolerance. How much volatility can you stomach? Your time horizon. If you're not retiring for 30 years, you can take more risk. But for most people in their 40s, 50s, or early 60s who are still accumulating wealth, 50-30-20 is a good target. For the 50% stocks, here's what I'd recommend. 30% U.S. Total Stock Market Index Fund, like VTI or ITOT. This gives you exposure to every publicly traded company in America. Large cap, mid cap, small cap, everything. 15% International Developed Markets, like VEA or IDEV. This is Europe, Japan, Australia, mature, stable economies outside the U.S. 5% Emerging Markets, like VWO or IEMG. This is China, India, Brazil, Mexico. Higher risk, higher growth potential. That's your 50%. Simple, low-cost index funds. No stock picking, no trying to time the market, just owning the global economy. For the 30% bonds, 10% short-term treasury bonds like SHV or BIL. 1 to 3 year maturities, safe, liquid, low volatility. 10% TIPS, like TIP, inflation protected. If inflation comes back, you're covered. 10% short-term investment-grade corporate bonds, like IGSB or VCSH. 1 to 5 year corporate bonds from strong companies. A little more yield than treasuries. That's your 30%. Stability, liquidity, inflation protection. This is the tricky part because private markets aren't as easy to access yet. But here's what you can do today. 5% REITs, real estate investment trusts. Not as good as direct real estate ownership, but accessible. Something like VNQ or IYR gives you exposure to commercial real estate. 5% commodities and gold. GLD for gold or DBC for broad commodities. Inflation hedge. 10% private market alternatives. This is where it gets interesting. Check if your 401k offers private equity funds, private credit interval funds, or infrastructure funds. If not available yet, you can access these through interval funds like Blackstone's BEIT for real estate, BDCs, business development companies for private credit, or tender offer funds. Or, if you're an accredited investor with income over $200,000 or net worth over $1 million, you can access private placements directly. I'll be honest, this 20% is still harder to implement than the other 80%, but it's opening up fast. At BlackRock, we're working to get these assets into 401k plans over the next few years. In the meantime, Even if you can only do 10% alternatives instead of 20%, you're ahead of most people. Once you've set your allocation, don't just leave it. Markets move. Your allocation will drift. Every quarter, check your portfolio. If stocks have had a great run, and you're now 55% stocks instead of 50%, sell 5% and move it to bonds or alternatives. This forces you to sell high and buy low automatically. It removes emotion. And this is critical. Don't react to daily news. Don't panic when markets drop. Don't get greedy when markets rise. Just rebalance back to your target every 3 months. Set up automatic investments. If you're still working, have a portion of every paycheck go directly into your retirement accounts. Dollar cost averaging, investing the same amount every month, removes the temptation to time the market. You buy in good times and bad, and over decades, this smooths out volatility. The best investors I know don't try to be smart. They just follow a system. They automate, and they stick to the plan. That's it. 7 steps. It's not complicated, but it requires discipline. It requires patience. And it requires accepting that the old model, 60-40, doesn't work anymore. Look, I've been in this business for 50 years. I've managed money through the inflation of the 1970s and 80s, through the crash of 1987, through the dot-com bubble, through 9/11, through the financial crisis, through COVID. And I can tell you this with absolute certainty. The investment environment changes. What worked for 40 years won't necessarily work for the next 40 years. The 60-40 portfolio was brilliant for its time. It made millions of people wealthier than they would have been otherwise. I'm not criticizing it. I'm just telling you its time has passed. 2022 was the proof. Both stocks and bonds fell together. That's not supposed to happen in a 60-40 portfolio. But it did. And it will happen again. We're in a different world now. Higher rates, persistent inflation, geopolitical instability. The correlations have changed. The assumptions have changed. And the institutions that manage trillions of dollars, pension funds, sovereign wealth funds, endowments, they've already adapted. They're already doing 50-30-20 or something close to it. But most individual investors haven't gotten the memo yet. They're still in 60-40 because that's what they've always done. That's what their advisor recommended 10 years ago. That's what the target date fund does by default. And that's a problem. Because if you're not adapting, you're falling behind. Now let me be clear. I'm not saying the stock market is going to crash. I'm not saying bonds are going to zero. I'm not trying to scare you. What I'm saying is this. The protective benefits of 60-40 are gone. The diversification you thought you had, it's not there anymore. And you need to adjust your allocation to reflect the new reality. 50-30-20 isn't perfect. No allocation is. But it's better suited for the world we live in today. It provides more true diversification. It includes assets that actually behave differently from stocks and bonds. And it positions you for the structural trends that are going to define the next 20 years. At BlackRock, we're betting billions on this transition. We're building the products. We're creating the access. We're democratizing private markets. And I believe that 10 years from now, 50-30-20, or something like it, will be the new standard. Just like 60-40 was the standard for the past 40 years. The question is, will you adapt early when you have an advantage, or will you wait until everyone else has already made the transition and the opportunity has passed? The choice is yours. If this video gave you clarity on where portfolio strategy is heading, I'd appreciate if you'd subscribe to the channel. We're going to keep exploring these institutional-level insights, the kind of analysis that typically only happens behind closed doors at asset management firms. Next video, I'll break down the 50% stock allocation in detail. What exactly should you own? How do you think about U.S. versus international? Growth versus value? I'll give you the specific funds we use at BlackRock. And in future videos, we'll dive deep into private markets. How to actually access them. Which platforms? Which funds? The stuff most people don't talk about because it's been restricted for so long. I'm Larry Fink. This is Larry Fink Perspective. The world changes. Your portfolio should too.